Okay,
It
woohoo.
was showing
That's
on my
awesome.
end for some reason. It wasn't letting me give you permission. So that usually I can give you permission. You don't
Yeah.
ask for it. I went to give you permission. For some reason, it was saying no. It's not me.
Thank you.
Okay. So regardless of what we're going to do, we're going to have to, figure this part out. We're going to have to say, okay, that's either 65 cents. I think that like if it is a dollar, I just think it's easier for me mathematically. I say,
Mhm.
okay, if I have 100 cents a dollar, because you could use one if you wanted. Math is kind of weird like that. There's lots of ways to do math. I had a guy in a 65 and I'm making him sound like he has hubris that he doesn't have because, dude, I'm not paying you $225 an hour to teach me math. I need two numbers I can solve for the third. I go, okay, fine. Now, good news, he passed because he was Dean Man. A lot of times they weren't asking me the math, they were asking me the formula, and that I didn't spend any time on. I had to kind of reverse engineer it. So, a couple ways to think of this. So, let's assume that we're considering buying a Ford Motor Company debenture with an 8% coupon or nominal yield. So, if we have that 8% is based on par. And that means we're going to receive $80 in annual interest from the bond, right? So now remember though, we said you don't get to keep uh, all that $80, right? We said if you're in 35% tax bracket, a couple ways
Mhm.
to do this. One way is I could say, okay, well, if I'm getting $80, but I have to give back 30%, 35% of that. So now I'm taking $80, boom, and I'm going to times it by 35% to see what the government's taking from me. And the government is taking $28 from this customer in taxes. And so what that means is that you're left with 80 minus 28. Are we clear where I got the 28? That's the 30% of the $80. So let's just put that up here. 80
Yeah, I get where you got that from, but what
time.
did you do with the 65, the point
Well, I'm going
65?
to show that to you in a minute. There's a couple ways to
Okay,
proceed.
okay.
So I'm showing you two ways, hoping one of the ways, it's kind of like a buffet, right? Seeing if one way is, you prefer one way better than the other. And here I found out that was $28. And so that means what you're really left with is an effective yield. Now, sometimes on the test, they use that terminology,
Mhm.
effective yield. And if you're getting 80, but you got to give 28 back, your effective yield is $52 or in bond speak, 5.2%. Now you
Okay.
said, where are we going to use that 65? Another way to proceed is you could say, I'm going to take the 8% and I'm going to times it by 100 minus the tax bracket.
Oh, okay. So
And
that's
if I
all in
do
one.
that math,
Okay.
so again, I got my calculator. And if I do that math, I say, okay, well, 80 times 0.65 is 5.2. Now, again, this is the test phraseology. What we've done here is figure out what's called the tax-free equivalent yield. I say in your tax bracket, getting 8 after you pay taxes is the equivalent of getting 5.2. Now, the reason this is important is because we have to make a decision about whether this bond is the way to go or not. That was a taxable yield. And so now kind of a thing we want to be able to do as a test taker here. What we want to be able to do as a test taker is now I got to say, okay, well, let me put that there. I say, Maria, in your tax bracket, a 4% muni makes no sense. A 4% muni makes no sense because even after you pay taxes on your taxable bond, you're still left with $52 or 5.2%. And so you shouldn't buy a muni that doesn't pay more than 5.2, right? And the
Okay.
test question here would be to say the customer should buy the taxable bond. But I could say on the test, your client's considering buying a 6% muni. Ooh, now I say, Maria, in your tax bracket, a 6% muni is better because that's $60 and that's better than $52 or 5.2. So the point here is I'm using that to make a decision. If the muni yields here, he buys the muni. If the muni's yield is down here, he buys the taxable bond. So this
Okay.
is two, as you said, more than one question here. This could be, can you do the math? It also could be suitability, making the recommendation properly, knowing what they
Okay.
got to do. Now, another scenario that shows up on the test. So here, what we did was we took the taxable yield. We took the taxable yield and we figured out the effective or after-tax yield. That's what we did. Now, another thing they might do on the test is tell you the muni yield. Say, Maria, your client, or you're considering buying a municipal bond. And you say, okay, so municipal bond I know is tax-free. I'm going to
Mhm.
make sure I buy the right bond for my customer so he's not going to have to pay any federal or state income tax. And maybe they say on the test, we're considering buying a 4% muni. And so now we say, okay, well, if we're buying a 5% muni, that is a tax-free yield. You're going to make 4%. You're not giving anything back to the government. And so I say that means you're going to get $40 and you're not going to owe any taxes. How did I get the $40? I got the $40 is taking par times the coupon, the nominal yield. You say, well, Dean, what would I need in a corporate bond? What would I need in a corporate bond to beat the muni? So in the previous example, we took a taxable yield and figured out what was the tax-free equivalent. We said a taxable yield of 8 in your tax bracket was the equivalent of 5.2 tax-free. Now we're taking the tax-free yield, and we're going to determine whether or not what we need to kind of beat the muni. So now we're going to take this tax-free yield, and what we're doing this time is we're going to figure out what is the taxable equivalent. I say getting 4% in this muni, Maria, is the equivalent of getting X in a corporate bond. All of this test is either multiplication or division.
Okay.
Most of it is division. So if you can't remember what to do on the test, divide. And if you
Okay.
can't remember what to divide, take the first number and divide it by the second number. That takes care of a lot of the math. Now, the way we're going to do this, we said we're always going to need 100% minus the tax bracket. We said you're always going to need that. And so the way
Okay.
we're going to do this math is we're going to take the tax-free yield, which in this case is 4%. And to go the other way, we're going to divide. And what are we going to divide by? We're going to divide by 100% minus the tax bracket. We said that's really the key. So as a test taker, maybe you see the tax bracket. I want you to just go ahead and take 100% minus that because you're going to need that no matter which way I'm asking you to go. This
Okay.
customer's tax bracket was 35%. And so we put that in there, boom. By the way, in terms of math, I'm not trying to turn you into a mathematician, God knows, but you always do parentheses first. So anytime you're looking at
Okay.
math, there's parentheses. You got to take care of the parentheses first, right? So when we do this, now let me show you what the happens here. We do 0.65. I'm terrible with arithmetic. So anybody offers me a calculator, I'm going to say thank you very much, right? So
Yeah.
I'm going to take my 4%. I'm going to divide by 0.65. And I say in your tax bracket, getting 4 is the equivalent of getting 6.5 taxable. Now, again, what's this mean? This means that if we can get you a taxable yield that is more than that, you should buy the taxable bond. And if we get you a taxable yield lower than that, then you should buy the muni.
Okay.
Right? So that's the whole point of why we're doing the math. So I would imagine as a test taker, the math itself is testable, but then making the recommendation based on that math is also testable, right? So we have to be able
Mhm.
to contrast the effective yield, that's a word they use, the effective yield of a taxable bond after paying your taxes with the effective yield of a muni and not paying taxes. So those are two things right there. Now you said you had more than one, and I'm not surprised by the way. I'm not surprised. So let's put a little in this document. You're recording, you're going to print this document and you're going to have
Mhm.
this document and you're going to go through this document. And what you're looking for is things like this, TQ means test question, where you say, oh yeah, Dean, I remember that. And what I want you to do is like each of these, like if you say, for example, you look at unsystematic risk and you say, I know what unsystematic risk is. It's, also known as selection risk, and it can be mitigated through diversification. If you think you own that intellectually, I want you to put a plus next to it.
Okay.
And you own it. And if you go look at opportunity cost, you go, I'm not quite sure what that's about. You put a minus.
Okay.
That means that's something that you want to, take care of, right? Right now,
Mhm.
we're saying you said you had a couple of these, and we're hoping that we're turning this from a minus to a plus, and we can say we own. Now, if you're not quite sure that you own it or not, then we're going to put a zero.
Okay.
What you're going to do is I call this an intellectual inventory of where you're at based on the content outline. So and
Okay.
remember, it tells you here. So the other thing I like is it matches up with what you told me, right, on your printout. So it matches your printout. As
Mhm.
you see here, there's 32 questions there,
Yeah.
right? If we go up here, if we just looking at this document, we go up here, it tells us, 20 questions here, right? So kind of helpful in terms of us helping to, model where we're at in terms of doing things, right? So boom, there's our munis, our corporates, foreign bonds. What do you know about investing foreign? Let me start with this. Why would you invest in foreign securities in general?
Um, because it's to diversify your portfolio. It provides
Absolutely.
you with more diversification
Yeah,
and
no,
just opportunity.
yeah. So Maria, now we got to just put some fancy words to it. You're absolutely correct. I had a young lady and we were going over 65 and I said, I want you to kind of project what you think the right answer is after we looked at the question. And she came with the most vulgar answer I've ever heard. It was correct, but it was in such street language. I said, now,
Oh.
you know that when we shop the answer set, that is not how it's going to, your answer is
Mhm.
correct. Now you just have to put it in legalese. You have to dress it up a little bit because this test is really, a bear when it comes to like grammar and the language.
Mhm.
So the answer that we would want you to come up with, you want to sound sophisticated, is it has different correlation to US securities.
Okay.
Right? Different
It's
correlation.
uncorrelated.
That's right, different correlation. We're hoping that it's going to have negative correlation.
Okay.
Negative correlation. That negative correlation concept is kind of important. Now, listen, I'm a big fan of Mexico, the Republic of Mexico. And right now they have a presidente. He's not very capitalist friendly. His name is AMLO's, his initials, Antonio Manuel Lopez Obrador. And another thing, when you
Mhm.
buy foreign securities, you have currency risk, but you also have political risk, right?
Mhm.
AMLO's been talking about nationalizing, foreign investments in Mexico. And, if you're an investor, you go, wait a minute. You told me I could invest there and I could have title and, I could be living large in Ensenada. Now you're telling me no.
Never
Right?
mind.
There's also associated with that. In any foreign investment, the other thing we ask you about is currency risk.
Okay.
This
Yeah.
idea that it used to take 10 pesos to get a buck. Now it takes 20 pesos to get a buck. We're going to test you on that in a lot of different ways. Dean, that's good because I buy tequila and now it only takes a dollar, gets me 20 pesos. My tequila costs me half as much, right? But it's bad.
That's fine.
My Mexican friends want to buy like a bulldozer because they're going to have to come up with twice as many pesos to do it, right? So they are going to
Mm.
test you on, this foreign currency kind of relationship. All right.
Okay.
So valuation factors of fixed income securities. Oh, okay. Well, here we go. We're poking around your brain housing group.
Mhm.
I say, Maria, you won the lottery. You won the lottery. You have a choice. Would you like a lump sum of $1 million? Or would you like payments of $100,000 a year for 15 years? This is a math question.
Mhm.
Now, I had a guy in one of my live streams who got really upset with me. And what he got really upset about was I said, listen, you don't really have to do this math. I said, in my career, I've had to do some serious math at some point along the way, 2, 3, 4 times. And I pay Guy Lee, he's made thousands of dollars from Dean because I don't want to do the math. And I know his math is pristine. And this guy said, oh, you shouldn't be in our business if you can't do your own math. I go, well, I hate to break the news to you. There's a lot of very successful people in our business who are math people. But anyways, I would call Lee and say, hey, Lee, can you do the discounted cash flow on those 15 payments? What I want to figure out, Lee, is what is the present value of 15 payments of 100,000? Now, the first major concept here, Maria, is that the 100,000 this year is worth less or worth more, excuse me, than the 100,000 15 years today. You know, when we're talking about time value money, money in the here and now is always worth more than money in the what? The
In the
future.
future.
So that's called discounted cash flow. So if we come up, and I'm going to apply it here to a minute to bonds. If we come up with a present value of 900,000, we should take the million. If we discover through discounted cash flow that 15 payments of 100,000 discounted today is 900, then we're going to say, you know, we'll take the million because that is a better number. Now, on the test, that would be called positive net present value. The idea that the present value is 900 and this is $1 million. I'm going to apply this to bonds in just a sec. Now, if on the other hand, we do the discounted cash flow, I'm not going to make you do it, but if we do that discounted cash flow and we come up with $1.1 million, then we say, ooh, $1.1 million is better than $1 million. I think we'll take the payments because by doing discounted cash flow, we've discovered that the present value is $1.1 million, and that's more than the million, right?
Okay.
Now, if we apply that to bonds, it helps us determine whether we have a good valuation. So here's where we're at, and I just want to tell you where I'm at because I'm going to do a little jump here in a minute. I'm right here on discounted cash flow. And I'm telling you that I'm not going to make you do the math, but I am going to ask you to recognize that math. So let me just go get here a slide deck I want to share with you and just show you a little bit more about this. There's 3, 4, perhaps 5 questions. Now, remember, the questions aren't, can you do the math? That's not what the questions are. The questions are, do you have a general idea of the input and the output? So let me go get this. Let me go find you again. Just give me a sec here. I'm pulling up a slide. Okay, so these are called, what I'm talking to you about right now is in this area where we said we want to do some more work. And this is what we call analytical methods in terms of valuation of securities. And so boom, boom, let me go find you again. And here's you. Where'd you go? There you are. Okay. Okay, can you see my slide deck?
Yes.
Okay, so I'm going to walk you through this area of your exam on discounted cash flow. So here's how I started this discussion with you. I said, we win the lottery. We want the $1 million, or do we want the 15 payments of 100,000? If we're looking at this bond here, we paid $925 for it. And what I'm trying to determine is whether 925, remember that's 92.5% of par. Right. So, if you're struggling on that, you got to, go back and do some review a little bit on, how we turn that into bond speak. Right. So it's like learning a foreign language. That bond is trading at a discount and that price is $925. And we need to know that 6.5% is known as the coupon, the nominal yield, the fixed or stated rate of return. And as we did earlier, we got to know that that means 6.5%. Then we're going to get $65 in annual interest. We also You know, the bonds pay semi-annually. Bonds pay semi-annually. So if this has 10 years to maturity, we're actually going to get 20 payments of 3250. That's the half of the 65. Right? So again, what we're going to try and figure out is what is the present value, very much like my lottery example. What is the present value of 20 payments of 3250? And the other thing we want to figure out is what is the present value of getting $1,000 at 10 years from now when we're paying $925 for this. We're about to do discounted cash flow. I'm not going to make you do the math. I'm just going to ask you to recognize the math, right? Okay, so here we go. The present value of the future cash flows. What we're hoping is that when we do the math, we find out that the present value is close to the price we pay. Because that means we got good valuation, good value. You know, this question is about good value and bad value. Again, not so much can you do the math. If we do the math and we discover that the present value of those 20 payments is 3250, not going to make you do it. I'm going to stipulate that when we did the discounted cash flow, the present value was 371.94. Very much like my lottery example, right? I just stipulated to you the present value is, right? And the present value here is 553.68. So if we take our calculator and let's see if we're happy with the price we paid. If we take our calculator and take 371.94 and we add 553.68, we find out that the present value is 553.68. And you know what we're looking for is to see whether we think we got a good deal or not. 553.68 plus 371.94. We find out that the present value is 925.62.
Okay.
And I think that sounds reasonable, right? I mean, it looks like we paid something close to that. I mean, that doesn't feel like we got ripped off. You know, in fact, we have positive net present value here, right? The present value is 925.62, and we bought the bond for less than that. So pretty good value. So let's now apply that to other bonds. Boom. There's what we are looking at. That is our present value. So we're considering buying a bond for 921.25. I go, woo, even a better deal. We got a free lunch here because we can buy today a bond that's present value is 925 for 921. Now the test question is not can you do the math, is can you tell me that's a good value? Because again,
Okay.
we're getting it for less than the present value. And can you tell me here that that's, by the way, again, that's 928.75, right? Eight, so you got to turn those eights into dollars. And here we'd say
Okay.
that's not a good deal because we're actually paying more, right? And that would be the test question. Now, can you apply discounted cash flow to stocks in terms of valuation? Could you apply discounted cash flow? We've just applied it to a bond, and we said, indeed, we can apply it to a
Yeah.
bond. You apply it to a stock.
Yes.
As long as the stock has a,
Dividend.
that's right. So when applied to stocks, test question, this is called the dividend discount model. You know,
Okay.
whenever I think of fundamental analysis, to say you're a fundamentalist does not mean you're a member of the religious right. You know, I think of Mr. Buffett. Now,
Okay.
Mr. Buffett has 1 billion shares of Bank of America, and Bank of America pays a 21-cent quarterly dividend. So what Mr. Buffett likes to do is say, okay, what is the present value of these dividends I'm going to receive? And he does present value. And let's say the present value of those future dividends from Bank of America is $25 and the stock's 24. He said, I think I'll buy some more Bank of America stock. If he does the discounted cash flow dividend discount model and he comes up with 26, right? Or comes up with the present value is of those future dividends is 25 and the stock's 26, he says, I think I'll take a pass. right? So this
Okay.
can be done with stocks. Bank of America's dividend used to be 18 cents.
Oh, wow.
Now it's 21 cents a quarter.
Mm-hmm.
If Mr. Buffett
Makes
makes
sense.
the assumption that the dividend is going to grow, then it's called test question, the dividend growth model.
Mm-hmm.
And the test question about the dividend growth model, a couple test questions. We can't use the dividend growth model with a preferred stock because the dividends don't what?
They don't grow
That's right. So that's a test
because
question.
there's a fix.
They're set, yeah, they're fixed.
Yeah,
The other
there's
test
fixed.
question is we can't if we do apply it, it will justify a higher valuation. A higher valuation because we would assume that those dividends are going to grow, right? So we'd be willing to pay a higher price.
Mm-hmm.
We assume the dividends are going to grow. So I wanted to show that to you. I departed from our we were looking at, oh, there you are, stop share. We were looking at the test specifications, and I took a little low budget Greyhound bus tour to talk about, again, this is the area we said we're focusing on finding you some more points.
Mm-hmm.
And we took a little budget down to Greyhound bus tour to talk about that. Now, we do have convertible bonds. And one thing you should be
Mm-hmm.
prepared to do on your test is tell me a conversion ratio when I give you a conversion price.
Okay.
Right? So if I tell you, for example, this is a Starbucks convertible debenture and it has a conversion price of 40, you should be able to tell me how many shares I can turn that into. Those conversion terms are based on par.
Mm-hmm.
So
So
we're
you
going to
would
take
get
par.
the $1,000 divided by 40, right?
We always divide. That's right. If you can't decide what to do, you divide. And if you can't remember what to divide, you take the first number and you divide it by the second number. Okay,
Mm-hmm.
so common stock. Why do we buy common stock?
Because it has bigger potential of growth.
Yeah, I like that. But again, everything you're saying is correct again, but we just got to tweak it a little bit.
We have to
You know, you're
spice
absolutely,
it up.
yeah, we got to dress it up. That's right. Jazz it up a little bit. So you're correct, but we have stocks that both have, dividends and do not have dividends. But the thing that's common stocks are very good at, your point about growth, is outgrowing inflation.
Inflation.
So if I ask you, what is a good inflation
Would
hedge,
be.
say common stocks or the
Mhm.
long-term common stocks are a pretty good hedge. Test question,
Okay.
what is the easiest way for you to get your client exposure in foreign stocks?
To buy index. No, to buy
American,
into mutual.
well, either a mutual fund, you're correct, but I was looking for an American depository receipt.
I see. What was your question?
My question is, what's the easiest way to expose your customer to foreign securities?
Oh, foreign securities. I
Oh,
didn't
that's
hear the
okay. That's
foreign
not a bad
part.
answer. By the way, not a bad answer. I tell you, that's one of the challenges on 65. I was just doing a practice final with somebody on a shared screen. And, a lot of times we're getting to the 50-50. And as their tutor, it's embarrassing. I go, I don't know. I could be wrong on this one because, I'm kind of prejudicial. I think they should have more stocks. And I bet you if we miss this, they're going to tell me that I'm too aggressive with this customer and they, shouldn't have that much stock in their portfolio. But even when I was a practitioner, Maria, I would tell people, listen, I'm prejudicial. Other professionals are going to probably tell you I got too much stocks in your portfolio, but they're over the long term. It's a good inflation
Mhm.
hedge, right? Um, Bond
Yeah.
rating. So the two major risks in bonds are credit risk and interest rate risk.
Mhm.
I always joke if anybody ever asks you about economics, finance, investments, and you want to sound smart, you should say it has a lot to do with interest rates. And if you just shut up, you sound good. You say, what about them? You say they fluctuate. And he says, is that good news or
Mhm.
bad news? You say, well, it depends. Can you tell me more? And then credit risk. Now, if you are buying a US government security, you do not
Mhm.
have credit risk. There's no better credit
Okay.
quality than that of the United States government. And muni bonds are the second safest form of credit.
Okay.
But we do have credit risk in bonds, particularly that are less than investment grade.
Mhm.
And below what rating under Standard and Poor's are bonds less than investment grade? Triple B is investment,
Triple B.
double B is less than investment grade.
Okay.
Can you mitigate the risk in junk bonds? We won't say junk bonds because on the test, one man's junk is another treasure. The answer is yes. You could diversify. You brought up a mutual fund, right? Why not buy a high yield mutual fund? It's unlikely all the bonds are going to default. But test question, the lower the bonds rating, the more credit risk you're taking in the customer's portfolio, right?
Okay.
And you need to be able to justify that. I mean, I shouldn't put a bond in there. For example, Ford issued some bonds that paid 8%, and I was thinking about buying 100 of them for my retirement plan. 100 grand, that's $8,000, 4,000 on January 1, 4,000 July 1st. I go, wow. But Ford Motor Company was rated C. Oh, C. Like, I mean, they may not pay me, so it's that kind of risk you talk about. Now, credit
Mhm.
spread always means difference. And the credit spread is the difference between what high quality bonds pay and low quality bonds pay. Spread always means the difference.
Okay.
Right. So one thing we like to do is keep an eye on what's happening in the marketplace. And one thing I might use in terms of doing that is following the credit spread. And I say, Maria, I'm a little concerned because the credit spread has been widening. It's been
Okay.
widening. And you go, well, geez, what the heck does that mean? I said, well, what that means is that the difference between high credit bonds and low credit bonds is widening. What that means is the money is in motion and people are selling their junk bonds, causing the price to go down, and buying treasuries, causing the price to go up. So if that credit spread is widening, that is a negative leading economic indicator. A
Okay.
widening credit spread, test question, is a negative leading economic indicator.
Okay. Widening. Okay.
Yeah. Lord John Maynard Keynes said money is like a giant floating crap game. It's always going from one spot to another, and this is telling us where money is going from. Now, the only two leading economic indicators you're held accountable for on the test are this one and stock prices. The stock market's all about earnings or future expectations of earnings,
Okay.
right? So, that's those two you're held accountable for. Okay, so we talked about common stock, we talked about foreign stock, preferred stock. What are the preferential treatment? Preferred stock has preferential treatment, test question, in two areas to the common. It's called preferred stock because it has preferential treatment in two areas.
Mhm.
You know what those two areas are?
They come at the time of a liquidation, they come before the common
Love it.
stock.
You're absolutely correct. They are senior to the common in liquidation. That is indeed the first way in which they have preferential treatment. Love it. You got that absolutely correct. What is another area in which they have preferential treatment?
Dividend payouts.
Absolutely, dividends. You can't pay a dividend to common if you're in arrears to your preferred stockholders. Does preferred stock vote?
Preferred stock, no. Only common stock
Right on. Good job. Good
votes.
job. As your tutor, this looks like we got to find you just a couple more points. It sounds like, you got some good base knowledge there. Some good
Okay,
base
thank you.
knowledge. If we're voting, do you have to attend a shareholder meeting to vote your shares?
No,
You
you
can
can give a proxy.
love it. Love it. Anti-dilution. So we have convertible bonds and people convert, we're going to have more shares outstanding.
Mhm.
And so, in a shareholder, you have the first right of refusal on the issuance of new shares. We say,
Mhm.
Maria, as a shareholder in our company, if we go to sell new stock, we're going to give you the first right of refusal to buy that stock. So you have 1,000 shares, you have 1,000 rights. You have the
Mhm.
right to buy the stock. You need to make up your mind quickly. Test question. Rights are short term because we need the money and we need it now. And if we can get that money from you, we won't have to hire an investment banker. So we're going to let you buy it at less than the current market price.
Mhm.
You have a right not to be diluted as an existing common stockholder. That's what we
Mhm.
mean when we say anti-dilution. What that means in plain English is we have to first go to our existing owners and say,
Mhm.
would you like to, maintain your proportion ownership and buy some more stock? Because if not, we're going to get it elsewhere. Now, you did tell me correctly that preferred stock is senior to the common stock.
Mhm.
In liquidation, I always joke capitalism without failure is kind of like religion without hell. And if we are going to liquidate the business, who comes ahead of the preferred stockholders?
Bondholders.
Right on. And now in the bond category, we have two. We have secured bonds and we have unsecured bonds. Who is senior in that situation?
Secured bonds.
Yeah, very test. We're going to ask you to rate them from senior to junior.
Mhm.
This guy today sent me an email. Do I have to go junior to senior? Yeah, you got to be able to do that both ways, right? Secured, unsecured, preferred, common, or common, preferred, unsecured, secured. Very much a test point, right?
Or sometimes they call it debentures, right?
Well, debentures are unsecured indeed. It's like
Unsecured, yeah.
I think
Okay.
at 65 is like learning a foreign language. And they say when you dream the foreign language, that's when you know it. So I guess when you have your first 65 dream. Listen, I got a late young lady. She's one of my favorites. I wasn't laughing at her. I was laughing with her, but I could tell she was a little perturbed. And her primary language is, can you imagine this is Mandarin? And
Oh
she was telling
wow.
me that she would put these words in like anti-dilution to her Google Translator, and nothing in Mandarin would come back. And she goes, "Why do you find that funny?" I said, "Because I don't think the 65 is in English to begin with. So I'm not surprised that nothing's coming back."
Nothing's coming back,
You
right?
know, yeah, I joke. I have attorneys sometimes take it. They go, "Man, Dean, if I don't pass, it's going to be embarrassing." I say, "Absolutely," because if anybody should be able to understand this legalese, it's certainly you, right? So I
Yeah.
don't. Now,
No,
restrict.
my first language is Spanish, and I didn't learn any
Yeah,
English until
Maria,
I was 14.
I wish I
So,
would have because man, if I could teach an Espanol, and then I was in college, what a dummy. I took French. Why would I take French?
oh,
That's so stupid. I should have taken Spanish, but my stepmother is a Mexican national. Her name is Alba, and when I visit them in Mexico, it's funny. She gives me a little bit of hard time because she goes, "You just told people you can't speak Spanish, and you just had a conversation." I go, "Nah, I kind of know where I should say sí or no or."
oh no,
Oh, I
yeah.
kind of a loose ace. We're talking about the lights, but it really gets me in trouble if she's not there because then I get in over my head really quickly.
Yeah.
I just say no, no, no. But yeah, so I think this is like a foreign language. Okay,
Yeah, it
so we
is.
have restricted stock.
Mhm.
Restricted stock, Maria, very testable, is stock that you did not get in a public marketplace. This
Mhm.
is stock you got directly from the issuer. Typically, this is stock you got is perhaps like in a Reg D private placement,
Mhm.
or maybe it's a stock you got from your employer. If you have restricted stock, it's restricted for how long before you can sell it into a public marketplace.
6 months.
Excellent, excellent, right? Then we can remove the restriction. We say, oh, you've had it 6 months, Maria. Well, that's fine. Let's remove that restriction. All right,
Okay.
dividends. Do you have a right to a dividend?
If you're like common, preferred
Only the
or
board of directors declares it.
oh, that yeah. Okay.
You
Yeah.
don't have a right to a dividend unless declared. No, Intel
Mhm.
recently said no dividends until further notice.
Okay.
It said we need all our resources to stay within the corporation to build chip factories and compete internationally. Here recently, Meta declared their first ever dividend. I said,
Wow.
wow,
Really?
yeah,
It's been a while.
yeah, they're,
Wow.
they're they're admitting that they can't spend all the money they're making. They say we can't spend all
Mm.
this money, so we're going to send it to our shareholders. Now, when we declare a dividend, it becomes a current liability.
Mhm.
Current liabilities are things we need to pay within the next 12 months. And one of the things you get tested on is a balance sheet.
Mhm.
And one of the things you get tested on a balance sheet is what's called working capital.
Mhm.
Working capital is the company's current assets, that's
Minus the
cash,
liabilities.
or things they plan to turn to cash within the next 12 months, minus their current liabilities,
Mhm.
right? And I just told you that if we declare a dividend, it's a current liability. So that would cause test question working capital to decrease. So
Mhm.
dividends, a declared dividend decreases working capital. You're not getting a whole lot of balance sheet stuff, but you'll get some. You'll get some balance sheet stuff. So as we said, this ain't a six, right?
Mhm.
It's got some more stuff on it. Okay, so the board's going to declare the dividend, and then they're going to say we're going to pay it to shareholders as of record.
Mhm.
We're going to look at our shareholder list, and if you're there, you get it. If not, you don't. And so we have what is called the X date. It's 1 business day prior to record. And I call you and I say, Maria, if you buy the stock today before the X, you get the dividend. But if you wait till tomorrow, no dividend for you. Am I a full service broker, or test question, violating NASA's policy on unethical business practices?
The second one, yeah, because you're
That's right.
selling
That's
the
a big no.
dividends.
You say, Dean,
Yeah.
isn't the stock going down by the amount of the dividend?
Mhm.
Should I be better served to not create the unnecessary tax situation?
Mhm.
And I say, yeah. Now we're talking about equity securities, and we said you might, through your employer, if you work at like Alphabet or Facebook or Google, get stock options.
Mhm.
And there's two types you can get. You can get what are called incentive stock options, and that is considered to be part of your compensation. And you have no cost basis on that. So when you exercise those, the entire amount is going to be taxable. This happened to Elon. Elon got this huge pay package, which included all kinds of Tesla stock, options to buy Tesla stock. And then when he invested, he owed $2 billion in taxes. He had to sell a bunch of Tesla to pay for it. Non-qualified means you're paying for the options after tax. And so you would have a cost basis on it. So that's the distinction. Technical
So
analysis.
so qualified stock is the one that you get given to you?
Yeah,
Is
that
that what
means
you're saying?
everything, yeah, all of it's going to be taxable to you. Incentive, everything
Okay.
is taxable.
Okay.
Non-qualified, the difference is taxable.
The
Now,
difference is taxable. Okay.
in technical analysis, we're going to be using charts.
Mhm.
Charts. What we're looking at is the demand and supply of the stock. Of the stock. And we're going to use charts to do that. Now, there's a lot of people who think technical analysis is hocus pocus because it's using information that everybody has. So one of the concepts we get tested on is this concept of alpha, excess
Yes.
returns. And there are some people that think alpha doesn't exist in any form. And that's called test question, the efficient market hypothesis.
Okay.
And the efficient market hypothesis says, there's no such thing as alpha. So why
Mhm.
waste all those times and resources trying to beat the market? And very tests will know that under all forms of efficient market hypothesis, technical analysis does not work. So, weak form says technical analysis doesn't work. That means if you believe in the weak form, you believe that like people like Mr. Buffett do exist. There are people who can beat the market,
Mhm.
right? But if none of us believe that technical analysis can beat the market, right? And then the
Okay.
strong form is nothing beats the market.
Not even insider
There
information.
you go. Perfect. That's
Yeah.
exactly right.
Okay.
Nothing beats the market. All right. Now you're going to get a lot more fundamental analysis questions than you are going to get technical analysis questions. And that's that balance
Mhm.
sheet I kind of warned you about. You are going to get tested on the working capital, current ratio, acid test ratio, debt to total capital. You won't get all those, but they'll all be in the answer set. And I'm either going to ask you to recognize them, ABC, what best describes working capital, current assets minus current liabilities, choice A. Or,
Okay.
current assets minus current liabilities is best described as, and you come up with working capital. But I'm wishing for you a dream draw this next time, not a face of death draw, right? But, we also could ask you to actually calculate those numbers, give you
Okay.
some accounts and say, what is this working capital, or what's the current ratio, or what's the asset test? And you might actually have to do it. Now, I did tell you about the dividend discount model. And I said the dividend discount model can only be used with stocks that pay dividends.
Mhm.
And then we said there's two, right? There's the dividend growth and the dividend discount. We said you can't use dividend growth with preferred stock. We said we could do it in a stock like Bank of America where you have the expectation the dividend is going to rise. And we said that would be a better price. Initial public offering. So we're going to have to register our IPO with the SEC and the states. How do we register an IPO with both the SEC 33 as well as with the states Uniform Securities Act? Do we use notification, qualification, or coordination?
Coordination,
Excellent.
because it's an IPO. Okay.
Excellent. Excellent. If it's trading in the secondary market, if it's trading in the secondary market, there's two. There's NASDAQ in New York, and the previous owner is receiving the proceeds. The test is way more concerned about primary transactions than secondary transactions. SPACs, blind pools, blank checks. We raise money and then we use it to go buy a company. Very aggressive. And the test question about a blind pool is the public offering price is going to be $10. So we're going to raise, 10 million shares at 10, and then we're going to, go ahead and go buy a business.
Mhm.
That makes sense at 10 because we don't have any business yet, right? So, it's kind of like a placeholder, if you will. All right. Well, I would hope that you would be pretty good on mutual funds. Our hour is up. As
Yeah.
your tutor, I'm pretty okay with what I discovered today is in your brain housing group. I think it's good. I
Thank
mean,
you.
almost everything, we just need to, just to tweak it a little bit. I think you got the
Fine
base.
too.
You just got the
Okay.
base, and what you need to do now is just kind of put it in this kind of language, right? You got to
Mhm.
kind of just like, okay, I growth. Okay, what, you just go connect the dots, just one more dot to get to
Yeah.
that right answer. And then the grammar, as we said, is atrocious. What's your plans? What's your plans moving forward from this tutoring session?
I'm going to, well, I didn't even know that there was a list like the one that you showed me that specifically outlines
Oh
everything.
yeah, yeah, yeah. You got to do that. There's your action item. You got to go do that plus
So,
minus thing. And
so
this is
I'm
not a
gonna do
transaction.
that.
This is a relationship. So you don't need book tutoring. If you just want to, if you just want me to
Yeah.
give you a Zoom and go over that with you, your plus minus, I'm more than happy to do that with you.
Yeah.
Right. And just
Yeah.
point you in the right direction. But that's that section. That whole section is the section that matches up.
That matches up.
What
Yeah.
we're
And
trying to.
I'm happy to see that I'm doing better on that with the questions that you asked.
Yeah.
Is there any advice that you have on better memorizing the formulas?
Oh,
Because I
no,
do
it's really a slog.
struggle with that.
Yeah, it's not, we don't have as many tricks and tips and memory aids as we do for other exams. It's a
Mhm.
slog for sure. I am sending you a very good document that I want you to look over. Save the practice exam, but do look over the front part of it is a PDF with all the stuff. And I want you to
Okay.
add that to your list of intellectual inventory. So do the same thing. Get the study specifications, the document I'm sending you, go through that PDF and again, do the say, oh yeah, yeah, I know that, or yeah, this is something
Yeah.
we're going to beef up. But save the practice exam because that's going to give us our final mark. Right?
Okay. Yeah. Yeah. I'll take those exams and then if I feel like I need more tweaking, I can
Yeah.
schedule another
Yeah,
session.
you can either schedule tuning or if you just want to chat, then just let me know and I'll send you a Zoom invite to chat and see what you want to do.
Okay.
Okay.
Sounds good. All right.
All
Well,
right.
thank you
I
so
a pleasure.
much.
Like I said, you're in better shape than I was expecting, on the tutoring session.
Thank
So,
you.
for what
Thank
it's
you.
worth, right?
Thank you.
Okay. All right.
Hopefully.
All
All
right.
right.
Bye
Have a
bye.
good one.